Government borrowing is the biggest issue in finance today.
The sovereign debt levels globally have just grown exponentially.
Governments around the world are addicted to debt.
Japan owes 235% of its entire economic output in debt. The United States, 124%. Italy, 137%. These aren't failing states. They're among the world's largest, most developed economies. And they're not slowing down. They're borrowing more every year. Here's the paradox. Debt is supposed to be dangerous. Financial responsibility means living within your means. Yet every major country, left-wing, right-wing, conservative, progressive, keeps doing the opposite. If debt is such a problem, why does no one stop? Your instinct about debt comes from personal experience. If you borrow too much, you eventually can't pay it back. Banks stop lending. Credit cards get cut off. The logic seems obvious, but government debt doesn't work like household debt. Countries don't retire. They don't have a fixed lifespan. They can roll over debt indefinitely, issuing new bonds to pay off old ones, as long as investors remain willing to lend. More importantly, governments control the rules of the game in ways individuals don't. They set tax policy. They influence their own currency. In some cases, they can even create money. The critical reframe: government borrowing isn't always a mistake. It's often a design feature of the system, a tool that governments use intentionally for reasons that make sense within the incentives they face. Understanding why requires looking at how the system actually works. Governments operate differently from households in one fundamental way. They spend before they collect. When a government builds a highway, funds a school system, or responds to a crisis, it doesn't wait until tax revenue arrives. It spends now and finances the gap by issuing bonds, essentially IOUs sold to investors who get paid back with interest over time. This isn't reckless. It's how governments smooth economic cycles. During a recession, tax revenues fall because people earn less and businesses make smaller profits. At the same time, demands on government rise. Unemployment benefits, food assistance, crisis response. Borrowing allows governments to maintain spending when it's needed most, stabilizing the economy rather than amplifying the downturn. Debt also funds things that pay off over decades: infrastructure that boosts productivity, education systems that create skilled workers, research and development that drives innovation. When a government borrows to build a port or train engineers, the economic return can exceed the cost of the debt itself. Here's the key concept most people miss. Debt is a tool. What matters isn't the absolute number. It's the cost of servicing that debt relative to what the economy can support. A country with low interest rates and strong growth can safely carry far more debt than one facing high borrowing costs and stagnant output. Japan's debt sits above 230% of GDP, yet its interest payments remain manageable because rates are near zero and investors trust Japanese institutions. The number looks terrifying, but the system functions. This is why debt keeps rising. It works until it doesn't. If borrowing is just a tool, why do governments use it so relentlessly? The answer lies in incentives, specifically political incentives that make borrowing the path of least resistance. Consider the alternatives. To avoid borrowing, a government must either raise taxes or cut spending. Raising taxes is politically toxic. Voters feel the pain immediately, and elections are never far away. Cutting spending hits visible services, schools, healthcare, pensions, creating vocal opposition from affected groups. Borrowing, by contrast, delays the reckoning. The benefits are immediate. Roads get built, programs get funded, crises get managed. The costs, higher interest payments, future constraints arrive later, often on someone else's watch. This isn't unique to any political system. Democracies face short election cycles, autocracies need to keep elites satisfied and populations pacified. In both cases, the incentive structure tilts towards spending now and worrying about the bill later. Add to this the expectations voters have come to hold. Modern economies are built on the assumption of growth, rising incomes, expanding services, improving infrastructure. Voters expect their governments to deliver, and governments borrow to meet those expectations. Finally, there's the crisis factor. Wars, pandemics, financial meltdowns. Governments respond by spending heavily, and revenue rarely covers the cost. After 2008, global debt surged as governments stabilized collapsing financial systems. After COVID-19, it surged again as they kept economies afloat during lockdowns. The pattern is consistent. Borrowing becomes the default because it's the least painful option right now, even if it creates long-term risk. Not all debt is created equal. Some countries borrow heavily and investors barely blink. Others hit far lower thresholds and face crisis. The difference isn't the number, it's trust. Take the United States. It borrows trillions, runs persistent deficits, and holds debt above 120% of GDP. Yet U.S. Treasury bonds remain the global benchmark for safe assets. Why? The dollar is the world's reserve currency. The U.S. has strong institutions, a diversified economy, and a long track record of honoring obligations. Investors believe they'll get paid back. Japan tells a similar story. Debt exceeds 230% of GDP, levels that would trigger crisis elsewhere, but most of that debt is held domestically, and the yen remains stable. The Japanese government has credibility with its own population and with global markets. European nations within the Eurozone face a different constraint. They can't print their own currency, so markets scrutinize their finances more closely. Germany, with its strong economy and disciplined fiscal reputation, borrows easily. Italy and Greece face higher costs and more skepticism. The pattern is clear. Debt is judged by trust, not just numbers. Countries with strong institutions, productive economies, and currencies investors want can carry more debt. Those without face harsher limits. This is why the US and Japan can borrow at low rates, while smaller or less stable economies face escalating costs at far lower debt levels. The system isn't fair, it's hierarchical. Trust determines capacity. So if trust determines capacity, when does borrowing actually become dangerous? The tipping point arrives when the cost of servicing debt starts crowding out everything else. Interest payments are an obligation. Unlike other spending, they can't be negotiated away. As debt grows, so do interest costs. If those costs rise faster than the economy, they consume an increasing share of tax revenue, leaving less for schools, infrastructure, defense, or social programs. This becomes acute when interest rates rise. A country that borrowed at 2% finds itself refinancing at 5%. Suddenly, debt that seemed manageable becomes a fiscal burden. Growth matters too. Debt is measured against GDP because growth makes debt easier to service. An economy that's expanding generates more tax revenue without raising rates. But if growth slows, or worse, turns negative, the debt burden increases even as the capacity to pay falls. Inflation complicates the picture. Moderate inflation quietly reduces the real value of debt, which is why governments sometimes tolerate it. But uncontrolled inflation erodes trust, raises borrowing costs, and can spiral into crisis. Currency weakness signals trouble. If investors lose confidence, they demand higher returns or stop lending altogether. This is especially dangerous for countries that borrow in foreign currency. They can't print their way out, and a collapsing exchange rate makes debt repayment impossibly expensive. Here's where the connection to our previous video, what actually happens. When a currency collapses becomes relevant. When debt meets lost trust, currencies feel the strain. A government that can't borrow and can't tax eventually faces a stark choice: default or debase. Both paths lead to instability. Once debt reaches a certain level, reversing course becomes extraordinarily difficult. Cutting spending is politically brutal. Every program has a constituency. Every service has beneficiaries who will fight to preserve it. Governments that try to impose austerity often face protests, strikes, and electoral backlash. Raising taxes slows growth. Higher taxes mean less money in private hands for consumption and investment. In a slow growth environment, tax increases can backfire, shrinking the economy and reducing revenue even as rates rise. So, governments keep borrowing. And here's the subtle mechanism that makes this sustainable for longer than you'd expect: inflation. Moderate inflation erodes the real value of debt over time. If a government borrowed $1 billion 10 years ago and inflation averaged 3% annually, that billion is worth significantly less in real terms today. Inflation acts as a quiet form of debt relief, painful for savers and creditors, beneficial for borrowers. This is why central banks in heavily indebted countries rarely let interest rates rise too far or let inflation fall too low. A little inflation greases the wheels. Too much triggers crisis, but too little makes debt harder to manage. The result? Debt often grows not because governments want it to, but because reversing it is harder than continuing. Each year's deficit adds to the stock, and the incentive to address it tomorrow remains stronger than the incentive to address it today. Here's what most people miss when they think about government debt. It isn't automatically bad. Debt finances infrastructure, stabilizes economies during downturns, and funds investments that drive long-term growth. Used well, it's a legitimate tool of economic management. The mistake is treating borrowing as a moral failure. It's not. It's a system response, a predictable outcome of the incentives governments face and the expectations voters hold. The real risk isn't debt itself. It's losing trust while carrying it. As long as investors believe a government will honor its obligations and manage its economy competently, debt remains sustainable. Once that belief cracks, once markets start doubting repayment or fearing inflation, the system unravels quickly. Countries don't borrow because they're reckless. They borrow because the system rewards it until it doesn't. And the line between sustainable and unsustainable is determined not by the numbers on a spreadsheet, but by the confidence of the people holding the bonds. Understanding this changes how you see fiscal policy. It's not about good versus bad. It's about trust, incentives, and the long, slow accumulation of commitments that can either fund prosperity or trigger crisis, depending on whether belief holds.